borrowing cost. A16 applicability. See, in your balance sheet, liability side, you have capital, equity share capital, preference share capital, retained earnings, non-current liabilities, current liabilities. Whatever the amount we generate now will be payable to these parties also. Equity dividend, preference dividend. For the retained earnings, they have to give at least growth. That's why equity shareholders are allowing you to retain their own earned money. I earned, rather than distributing, it is reinvested. No, they will demand some extra growth. And for the non-current liabilities, interest is demanded. This component is going to be studied under AS number 16. Amount payable to them is not going to be studied here. Remember, especially in case of preference share capital, no. If that preference share capital resembles like non-current liabilities, then that will also be considered as loan, and borrowing cost will be applicable for the preference share dividend payment. They will demand just similar to the debenture holders. Clear? So for all these things, amount payable to the non-current liabilities, then amount payable to the preference share holders, provided if the preference shareholders are par with the liability. Okay. So AS number 16, borrowing cost applicability. For equity share capital, not applicable. Retained earnings, not applicable. Preference share capital, not applicable, provided if the preference share capital classified as a equity. Same if the preference share capital classified as liability, yeah, of course, this borrowing cost will be applicable. Now, in this chapter, what is called borrowing cost? What is called borrowing cost? You, from the lender, you borrow the money, say 10 lakhs. Anyhow, this is going to be refundable on the maturity date. Meanwhile, now and then you have to pay the interest for this. Cost you spend for arranging this. Okay, cost of spend for arranging this. And you borrow 10 lakhs, on maturity you have to repay 12 lakhs, like zero coupon bond. That additional payment you're supposed to pay later on will also be your cost. So these are costs. It's not only interest. Now you have to understand what is called borrowing cost. It's not only interest, it includes other costs also. What are they? Interest and commitment charges, amortization of discounts and premiums for borrowings. Okay, you borrow 10 lakhs, repay 12 lakhs, and the difference between these 12 lakhs, 2 lakhs will be for over 5 years, means every year 40,000 will be considered as cost for the borrowing every year. Any ancillary cost, like cost of arranging the borrowing, finance charges under finance lease for asset acquisition. Now, fifth is very important here. Exchange differences arising from foreign currency borrowings to the extent interest cost us as per para 4E of AS 16. I deal it along with illustration for your better understanding. You no need to worry about that. If you are borrowing from foreign country, why do you borrow from foreign country? Maybe the interest rate in foreign country may be cheaper. Okay, because of that reason you borrow. But what happens here? At the time of payment, you borrow when per dollar is 80. Okay, the rate of interest being only 4%. In India, it is 8%. So you prefer to borrow in US, foreign, where you pay 4% only. No, 4% on this being 3.2 will be your rate of interest. Same, if you are borrowing in India for 80 rupees, 8%, 6.4 rupees will be the interest payment. Am I right? So you save how much? 3.2. How much will be your borrowing cost? 3.2. Now in direct taxation, you might have learned that any interest you pay for procuring the asset up to the date of put to use will be capitalized. After that, that interest will be debited to the P&L account. That's how you might have studied. Similarly, if I ask you the question, will I be able to capitalize this by adding to the cost of asset? Yes, of course, 3.2 can be addable. If you borrow in India, how much you have to add? 6.4. As you borrow from foreign country, you need to add only 3.2 because you are paying only 3.2. Suppose 1 year later, while repaying the loan, per dollar price is now 85 rupees. So I borrowed $1, now I have to pay $1 back. While borrowing that $1 converted into Indian rupee, it is only 80. By the end of first year, for repaying, I need to have $1 to repay. For that, now I have to pay 85 rupees, 5 rupees excess money is there. Apart from the interest, I have to pay another 5 rupees. So what is my cost? 3.2 and 5 rupees due to the exchange difference. I have to pay 8.2. Why do you borrow from foreign country? Rate of interest is cheaper. Now what does the thing happen? Rate of interest cheaper, sir, because of the exchange difference I am supposed to pay more. Then how much can be capitalized for adding the assets cost? Not more than the rate of interest, amount of interest payable in India. Otherwise, amount of interest payable in India, interest and foreign exchange difference both put together in foreign country, between these two, whichever is lower will be considered as capitalizable cost. It can be addable to the cost. Then excess payment, 6.4 and 8.2, the excess payment is how much? 1.8, 1.8. This 1.8 is nothing but amount debited to the P&L account expenses. That will be studied under which one? Fifth aspect. Is that okay? So these are the 5 aspects are going to be covered here. So we have the illustration for the fifth. The rest will be very easy. Now accounting treatment that you know. Normally interest is debited to P&L account. Exception, interest is capitalized when you borrowed the money for construction of asset, not for purchase of the asset. For the construction of asset, you borrowed and you spent the money for construction. It took around 3 years. Before the asset gets completed for the required purpose, we paid around 3 lakhs rupees interest every year. Means for the 3 years, 9 lakhs you paid. So the amount you spent for the construction of assets plus 9 lakhs interest you paid during the construction period, no pre-construction period interest, should be capitalized. So now the asset value is the amount spent plus this 9 lakhs. Once the asset is ready to use, thereafter any interest is payable can be debited to the P&L account because the asset is now generating the revenue. The revenue generated by asset is transferred to the P&L account's credit side and borrowings related to the particular asset is now debited to the P&L. So that's all. The same logic you might have studied in your direct taxation chapter also. If loan is for direct attribution to acquisition, production or construction of qualifying asset. What is called qualifying asset? The asset is taking substantial period to get it ready for the intended use. I purchase and the next day install and use. No capitalization. Okay, I procure the raw materials and all and I take around 3 or 4 years for the construction. After the completion of the construction only, the asset is ready for use. During the construction period, if you are paying the interest, then it will be capitalized. Means substantial period. Qualifying asset means the asset takes substantial period, minimum 2 or 3 years before it gets ready for sale. Then only this amount will be capitalized. And because of this payment, you need to get the future economic benefit. Means you constructed the asset, that asset gives you benefit for more than 1 year. These two conditions satisfied, then that interest, that borrowing cost can be capitalized. Seems to be similar to what? Interest concept we learned in direct taxation. Right. So qualifying asset. What is called qualifying asset? Asset takes substantial period, usually more than 12 months to get ready to use for intended purpose. What are called the qualifying assets? Property, plant, equipment in construction process. Intangible assets under development phase. So intangible assets takes 3 years or 4 years to get it developed for intended use, brand, technical know-how, even some probably this one patent and all, no. So COVID season, no, COVID, Covaxin and the Covishield, they spend around 2 or 3 years to get it ready with huge investment. Those investment will be considered as intangible assets for developing the Covishield and Covaxin. That's means royalty. Means brand name, patent. That will be intangible assets. But 3 years taken, no, during the 3 years period, if you pay any interest, can be capitalized. Investment in properties. Investment in properties. Building meant for capital appreciation, earning rental income, but not being investment held as financial assets. You have surplus money, temporarily purchase an asset, okay, a land and building, that 3 or 4 months later, if you're supposed to sell, then this is not qualifying asset. Okay, and can that stock in trade being qualifying assets, sir? Yes, stock in trade also be qualifying assets provided what? That stock in trade takes substantial period before it is ready for intended purpose, intended sales. For example, in case of wine and basmati rice and all, no, at least you have to keep in brewery that wine 3 or 5 years. During the 3 or 5 years, you invested the money and kept there, that investment is out of borrowing. And 5 years later only it comes to the market, means what happens for 5 years, you may pay interest only, that interest will also be addable with the wine price, and in case of basmati 2 or 3 years, that also be included. Clear? Okay, it takes substantial period before sale. In these cases, we can call this being the qualifying assets. Qualifying assets not necessarily only capital asset, it may be stock also. So, you may study under PPE, under AS number 10, as well as inventory under AS number 2. There, very often we refer this particular point. Borrowing cost as per AS number 16 will be addable with the cost. Now you see AS number 16, what are the costs are going to be addable to the cost of the property, plant, equipment, cost of the stock is mentioned here. Hope you will be able to understand this one. So I will deal this one. Okay, now let's start with first one. What's that? Borrowing cost from foreign currency. Just now I explained, no? Let's now try to solve this illustration. We can solve this very easily. Yeah. XYZ Limited has taken loan US dollar 10,000 on April 1, 2021. April 1, 2021. Borrowings being $10,000 for a specific project at an interest rate of 5%. Applicable interest rate being 5% here. Payable annually. Okay. On 1st April 21, the exchange rate between currencies was 45. In this case, rupees per dollar, 45 rupees. The exchange rate as at 31st March 2022 in the year end, 31st March 22. Okay, per dollar being 48. The corresponding amount could have been borrowed by XYZ Limited in local currency at an interest rate of 11%. If you could have borrowed in India, the rate being only 11%. If it is being India, this is the rate 5% in case of borrowing being in dollar. This is the rate of interest in case of borrowing being in rupees. So you borrowed from foreign country, thinking that rate of interest is cheaper. Okay, that rate of interest can be capitalized, but because of the exchange difference, you're supposed to pay extra. That extra will be capitalized only restricted to the extent of Indian rate of interest. Okay. Now, let's try now. What happens? What is the interest amount you're supposed to pay? Interest paid for $10,000 at the rate of 5% you pay. By the time the rate applicable being 45, come on, find out the value. No, you multiply with the current rate, because we assume that rate interest is payable in the year end 48, 24,000 is the interest paid. Okay, now the problem is what? You can still add what? Exchange difference, if any. 45 becomes 48, means for every dollar you have to pay 3 rupees excess. 3 rupees excess you have to pay. That 3 rupees is naturally loss only, no? $10,000 into 3, 30,000 loss. Can I capitalize this amount? Can be, but maximum capitalization value is not beyond that 11% value. Okay, now see. Add exchange difference, if any. Exchange loss, if any. Where whichever is lower of excess payment due to exchange difference. Exchange difference. How much? 48 paid instead of 45, 3 rupees excess per dollar. For $10,000 you pay 30,000 rupees. 30,000 rupees. Now, how much interest you saved because of borrowing in foreign country? Interest saved. How much? 11% you have to pay in India, but you paid only 5%. You saved how much? 6% on your borrowings. On your borrowings. Okay. Now, what is your borrowing? At the rate of 45. That date rate. That date rate. Okay. 10,000 into 45. $10,000 per dollar costing 45. Come on, get me the value. Huh? 6% on 10,000. $600 into 45. Is it so? Okay. Do this way. Interest save. What is the interest you need to pay in India? $10,000 per dollar 45 means you are getting 4.5 lakhs loan in India. Rate of interest applicable in India be 11% minus actually you paid only 24,000 means this is savings. Come on, tell me. Okay. You can then follow this method. Okay. 25, 500 will be the answer. So between these two, whichever is lower can be capitalized. Okay. How much? 49, 500 can be capitalized. Clear? So actual exchange difference loss being 30, but you are able to capitalize only 25, 500. What about the difference between these two? 4,500. This is not capitalized, then it should be debited to the P&L account. It can be debited to P&L account. It can be debited to P&L account. Is that clear? I am recalculating the same illustration assuming if the rate of interest in India being 13% in this scenario. Come on, interest paid. How much is that? 24,000 plus exchange loss if any will be addable. Whichever is lower of number one exchange difference. How much is that? That will be 30,000. Second one being interest saved. Interest saved. $10,000 at the time of borrowing it is 45 rupees per dollar into 13%, not 11%. This is the interest you are supposed to pay in India. Because of borrowing from foreign, you pay only 24,000. Okay. So we got stuck here 27 and 25. No, that difference 1,500 due to this value. The 3 rupees excess amount. No. 10,000 into 5% into 3%. If you put the value, that will be 1,500. Here we take 45. Here we take 48. That's the reason. Okay. You can go with this model only. 10,000 into 45 into 13% minus 24. What's the value you are getting? 34,500. How much you can capitalize? All the exchange loss can be capitalized. There is no non-capitalized exchange loss transferable to the P&L account. So P&L account will have no amount to be shown. If you are paying excess, okay, then automatically due to the exchange difference, automatically cross verify whether it is not beyond interest saved. Okay, if it is beyond interest saved, this loss can be debited. Otherwise, it can be capitalized. Clear? So main concept is over. If it is clear, text me. We'll move on to the next one. Let's move on to the next illustration. Online students, come on, text me. Yeah. Now, listen. Recognition of borrowing cost. How do you recognize the borrowing cost? Directly attributable for the acquisition, construction, or production of qualifying asset, including capital assets as stock in trade. Then capitalize. No, sir. Then it can be debited to the P&L account. Very simple. That's how we can recognize. And types of borrowing cost. We have specific borrowing as well as general borrowing. We have specific borrowing and general borrowing. I want to construct a factory stating that I borrow, say, 10 crores. Then that is a specific borrowing. I borrowed for my business, and out of the borrowing I can use it for day-to-day operations. Some money is for purchasing the raw material. Some money is for purchasing some assets or construction of assets. That is called general borrowing. Specific borrowing also can be capitalized. General borrowing can be capitalized only to the extent amount used for the construction of the qualifying assets. But general borrowing, we may have 2 or 3 different general borrowings. We'll have totally different rates. Then you have to take weighted average cost of capital. Anyhow, let me finish up an illustration to make you understand the difference between these two, so that subsequent learning, remaining theory part, you can complete easily. Let's start with the first illustration, question number 1. Now, Rainbow Limited borrowed an amount 150 crores on 1/4/2008 for construction of boiler plant at the rate of 11% per annum. Plant is expected to be completed in 4 years. Since the weighted average cost of capital being 13%, the accountant Rainbow Limited capitalized 19.5 crores for the 150 crores. So, 150 crores into 13% they have calculated. How much it is for 4 years? Come on. For per year, this is for current year only. How much? 19.5. For this year, they are capitalized. Every year, they have to capitalize this amount until 4th year. But actually, the borrowing meant for this purpose is 11%. 11%. This is weighted average cost of capital. Then how much it should be? Now, first capitalization will be done to the specific borrowing. If you borrow for the specific assets, the cost for that specific borrowing is going to be capitalized for that asset. In the absence of specific borrowing, it seems to be general borrowing, then weighted average cost of capital can be used. Here there is a specific borrowing. Specific borrowing is there, no? So you have to take the specific borrowing only. And the accountant referred the weighted average cost of capital. That will be applicable only for what? General borrowing. Okay, means the asset constructed out of the general borrowing, not specifically mentioning this is the purpose I am borrowing to the banker. Okay, then it is general borrowing. General borrowing will be applicable only if you have not stated the borrowing is for what purpose, but here already you stated. The accountant of Rainbow Limited told this. An income of 3.5 crores was earned and credited to the profit and loss account. Okay, so they borrowed 150 crores. Though they borrowed 150 crores, they will not invest the entire 150 crores in the day one itself. They will gradually invest. Am I right? They will gradually invest. Okay, 1 full year. The construction is going on. Initially 20 crores, 30 crores. Meanwhile, the amount left in the bank account itself. As it is being the bank account, you earned 3.5 crores. This 3.5 crores then naturally credited to the P&L account. This amount capitalized asset. This is credited to the P&L account as a revenue. Comment on the above treatment. First one, this is wrong. This one is wrong. We cannot take the general borrowing rate here. General borrowing rate is not acceptable. Okay. Now, can we do this one is debit, this one is credit? Okay. No. You have to subtract this value from here because these two are related to the borrowing only. No. For the borrowing, you pay 16.5. In that same borrowing, you earned 3.5. Net amount payable for this purpose is 13 crores. So you have to capitalize only the 13 crores, not the full value. Hope you will be now able to understand two aspects. Clear? Now, see. Specific borrowing will be capitalized. Actual borrowing cost will be taken minus income from the temporary investment of the borrowing. Hope you will be now able to understand. So 16.5, income being 3.5, subtracted 13 crores only capitalized. In case of general borrowing, the calculation is pretty different. Okay, we have to use which method? Weighted average cost of capital. We'll see that, and later then I'll explain the point number B also. Let's go for the question number 2. Come on. You can guess and tell me. What are called qualifying assets? What are called qualifying assets? Okay. Now, PRM Limited obtained a loan from bank 50 lakhs. It is utilized as follows. Now, what happens here? This borrowing is not meant for any specific asset, then it will be called as general borrowing. In case of general borrowing, you have to take weighted average cost of capital. Right. Construction of shed was completed in March 2022. The machinery was installed on the date of acquisition. Shed. Okay. Delivery truck was not received. Delivery of truck. Truck purchased. Okay. Purchased means this will not be qualifying asset. Because there should be substantial period before it gets ready. So you cannot capitalize this one. Okay. And the total interest charged by the bank for the year ended being 18 lakhs. How much is that? 18 lakhs. Overall spending being how much? 120. And overall interest payment being 18 lakhs. Show the treatment of interest. Come on, tell me. Purchase of machinery. Will it be qualifying asset? No. Usually purchase will not be qualifying asset. The next day itself we start use it. Working capital, it's not asset at all. It's operating day-to-day expenses, not. Purchase of truck, it's not delivered. We're not sure whether it's going to be taking substantial period or not. Usually not so. Only for this you can claim. Only for this you can claim capitalization. Okay, capitalization. For the overall spending 120, your overall interest payment being 18 means for 50, how much can be capitalized? That's how you can get. Though the loan is 50, I cannot take entire 50 for him. That entire 50 is for this. That's how you cannot argue. The amount 50 lakhs is meant for shed. That's how you cannot argue. It's a general borrowing. In case of specific borrowing, entire 18 lakhs can be capitalized, but it is general borrowing. So this 50 lakhs is for all the 4 items. Out of all the 4 items, 150 rupees is borrowed. Okay, out of 120 rupees investment requirement, 70 is own fund, 50 rupees borrowing. Similarly, here also 50 being borrowings, another 70 being own fund. 50, 120. Only to that extent of that entire borrowing, 50 by 120 can be capitalized. How much is that? 7.5. 7.5 can be capitalized out of 18. Balance 10.5 cannot be capitalized. If it is not capitalized, then it can be debited to P&L account. Hope you will be now able to understand. Question number 2. Shall I move on to the next one? Question number 3 is a comprehensive illustration. Once I complete this chapter is over. Third question is the comprehensive illustration. With that, the topic is over. One more variant, question number 4 and 5 we'll discuss. 3 and 4 are similar sum. For the same model, I solved I may solve two illustration 3 and 4. Fifth is a variation. With that, all the valuation calculations are over. Now let's start with the question number 3. Question number 3. Okay. Now, Paras Limited has the following borrowing during a year in respect of the capital expansion. Plant P, Plant Q, Plant R. Overall cost of the assets being 400 lakhs. And there is no specific borrowing for Plant P. 35 is for Plant Q, 125 is for Plant R. These two are what? Specific borrowing, 190. Out of 400, 190 being the specific borrowing. Specific borrowing means applicable rate of interest for that borrowing will be capitalized. No problem. In addition, another 210 balances, no, that will be from general borrowing. In addition to the specific borrowing stated above, the company had obtained term loans from banks, term loan, without stating why I am borrowing. It's general borrowing. They have borrowed two loans here, 100 plus 110, overall 210. So out of 400, 190 is the specific borrowing, 210 is the general borrowing. In case of general borrowing, we have to use the weighted average cost of capital. How do I calculate that? For 100 lakhs, rate of interest being 10%. Okay. Then what about the interest? 10 rupees. For the another 110, rate of interest being 11.5. What is the amount of interest? 12.65. What is the total borrowing? What about the total interest payable for that? 22.65. Otherwise, 22.65 you have to pay for 210, which is the average rate, otherwise named as weighted average cost of capital. Those who have studied financial management, you might have studied the weighted average cost of capital also. Cost of equity, cost of debt, and you have to group that to find out the cost of overall capital. That's the calculation. Weight of debt, weight of cost of equity, weight of debt, cost of debt plus weight of equity, cost of equity. That's how we'll do. No, that way also it can go this way, this angle also. The rate being 10.79%. Now come on, we'll start with the plant P. For P, 100 lakhs, no specific borrowing. Then what about the nature? General borrowing 100 lakhs. In case of Q, 125 in total. Out of that, 65 lakhs being specific borrowing. In case of specific borrowing, applicable rate of interest for that being 10%. General borrowing means 10.79%. Out of 125, 65 specific borrowing means balance we may assume being out of general borrowing 60. In case of general borrowing, the rate being 10.79%. Similarly, in case of R, the overall requirement being 175. For that purpose, we borrowed 125 by issuing the debenture. So, specific borrowing 125, that one charged at the rate of 9%. Balance will be as per the general borrowing rate will be taken. So, 50 into 10.79%. Clear? Yes. Come on, tell me. In this case, 100 into 10.79, 10.79 to be capitalized. This is what about the capitalizable value. Capitalize. Then what about the cost of the asset? 100. If you capitalize this, hereafter the cost of the asset being 110.79. And in this case, 65 into 10, 6.5. And for the 60 general borrowing rate, 6.47. Now you have to add up these two with the 125. You have to capitalize this value as well. Specific borrowing should also be capitalized, general borrowing should also be capitalized. 137.97. And this one, 125 into 9%, 11.25. Here, for the balance 50, 10.79, 5.75. 39. Then the cost here being 191.64. And what about the total interest capitalized? 40.40. Okay, what about the general interest capitalized? What about the general interest capitalized? You understand now? Total interest means all the three items put together. Okay. General interest being 11.86. Then balance will be specific in borrowing, specific borrowing interest. That will be, I doubt, specific borrowing be, you have to add this one and this one, total 17 point, then it should be wrong, no. You have to add 10.76, 79, 6.47, 5.39, you have to add the 3, 22.65, okay. Why do I calculate this last one? Already over, sum is over. Why do I calculate the last one? Now remember, if there is any temporary income generated using the borrowing until it is used, should be subtracted. Should be subtracted. Next. Should be compared with the actual interest payment for the general borrowing as well as specific borrowing. If the actual interest payable for the general borrowing is only 20 means you have to capitalize only to the extent of 20, not 22.65. Why, sir? We found out the rate. Suppose there may be waiver of interest. Ahead of the time you might have paid that interest, means loan repayment. So the actual interest may vary. That's the one point. Whenever you capitalize, always cross verify. Most probably there will not be an issue, but anyhow cross verify that capitalized interest should not be more than the interest actually paid. Hope you will be now able to understand. The second part I will explain later. That's how I told earlier. Amount capitalized should be less than or equivalent to the total actual borrowing cost for the period. Are you able to understand? So while capitalizing, specific borrowing can be capitalized subject to any income recovered during the short period. In case of general borrowing, capitalized expenditure on assets and weighted average cost of capital, provided only it happens in case of general borrowing. Because general borrowing, we are not sure whether it is for that or not. So, amount capitalized should not be more than the amount you pay for the borrowing. This will be applicable at least for what? This purpose. Okay. For general interest purpose. So, this is what about the capitalized interest. Assume if the actual interest paid because of some reason, waiver is there, then it cannot be more than 20 lakhs. More than 20 lakhs means proportionately you have to add, not full value. So here you added 6.47 now? No, you have to restrict as per the proportion. We have calculated in the very first illustration. This is how you can calculate. Out of the amount spent, 50 out of 120 is for this, means to that extent only you have to capitalize. That's how you can do in case of general borrowing. Clear? Come on, make a note of it. Now, see, you borrow 10 lakhs, but you use initially 3 lakhs, then 2 lakhs, and again 2 lakhs, and finally another 3 lakhs within that year. So, after 3 lakhs, still you have 7 lakhs in your bank, 5 lakhs in your bank, 3 lakhs in your bank, and 0. As these are the amount available in your bank, you may get interest, Then what the interest you pay for the 10 lakhs, from that the interest recovered is subtracted. That amount will be capitalized in general. But in another case, general borrowing, or the banker says, sir, I don't pay you 10 lakhs. If you spend the 3 lakhs, ask me, I will pay 3 lakhs. If you spend 2 lakhs, I will pay 2 lakhs. So then there will not be balance at all, So the capitalizable interest is only for the amount you have for the period. Probably this 3 lakhs you spend on year beginning itself, 2025. This 2 lakhs you spend on 1/7/2026, 25. This you spend on 1/11/2025. This you spend on 28th February 2026. Now you can calculate the interest for the whole year for this to capitalize. For this from 1/7 to the year end capitalize. For this you can capitalize from 1/11 to the year end, and this will also be capitalized only to the date of spending to the year end. Possible. Usually this point will be applicable for the general borrowing, not for the specific borrowing. Related to this one, we'll be solving the next illustration. The rest of the things are the normal. Okay. Now. Okay. In case of general borrowing, these are the scenarios you have to understand. To the extent amount spent, you have to capitalize. To that extent of period. Okay. Mrs. Ayush Limited began construction of a new building on 1st January 2017. It obtained 3 lakhs a special loan to finance the construction. Then it is specific borrowing. In case of specific borrowing, you don't have any confusion. Okay, finance the construction on the building on 1st January. At the time of construction itself, we borrowed. So this 3 lakhs capitalized. Interest on this 3 lakhs can be capitalized. 3 lakhs into 12% for the whole year capitalized, there is no doubt. The company's other outstanding 2 specific loans are here. Okay, non-specific, then it is general. Then what about the weight? So in the case of general, you have to calculate weighted average cost of capital. So you have to multiply these two to find out interest amount. How much is that? 66,000. And here 1,43,000. Am I right? Yes. 2,09,000 is the total interest for 70 lakhs of your borrowing. Then what about the weighted average cost of capital? Divide this interest by this borrowing. 12.29. 12.29% is the general borrowing. This is general borrowing. We have the specific borrowing and we have the general borrowing. Clear? The expenditure that were made on the building project were as follows. January 3 lakhs, April 3.5 lakhs, July 5 lakhs, December 1 lakh 50. Lots of confusion is there. Then how can we do? We have to find out the weighted spending. Weighted spending means what? Weighted spending. Assume that the spending happens in the month beginning. Year end being 31st December 2017. This 3 lakhs spent on day 1 itself, so eligible for 1 full year's interest. 1 full year's interest. And this spending is on April. From April to this period, 9 months. So 9 months interest only will be eligible. For this one, July to this date, 6 months. Am I right? 6 by 12. And this spending is eligible for December to last date, only 1 month. If you multiply these two, then you will consider this being the weighted borrowing, weighted spending. 3 lakhs into 1, 3 lakhs. And here 3.5 lakhs into 9 by 12. 62,500. Here 2,75,000. Here 12,500. Total 8 lakhs 50. Now this will be considered as your borrowing. Here specific borrowing is how much? 3 lakhs. In case of specific borrowing, the rate applicable for the specific borrowing will be taken, which is 12%. Balance will be general borrowing. How much is that? This will be capitalized at what rate? Weighted average cost of capital being 12.29%. So here 36,000 for the general borrowing, capitalizable amount being 67,595. Total value to be capitalized being 1,03,595. What is the journal entry for this? Building account debit, the asset account debit to bank. The interest payment is now shown here. Otherwise, if you pass the entry like interest account debit to bank, then here building account debit to interest. That's how you can capitalize. Usually interest account debit to bank, later that interest is debited to the P&L account, no. But here it is not debited to the P&L account, it is added to the building account. So if you are asked to pass a journal entry, this is the method you have to follow for passing the entry, which is 10 lakhs, 1 lakh 3,595. So in your balance sheet, okay, capital expenditure under construction, okay, building under construction or capital work in progress. What is the value? What is the value? Already we spent so much. How much is that? 13.5 lakhs. 13.5 lakhs already spent. Apart from that, 1 lakh 3,595 also be capitalized. So the value of capital work in progress being 14 lakhs 53,595. Is that clear? That's how you can show. You have to add that interest with the capital expenditure you spent for constructing the property. Clear? Now, this question, pretty interesting question. The beauty of this question is general borrowing. That too, borrowing is not permanent, it's overdraft borrowing like. Overdraft borrowing like. XYZ Limited has undertaken a project for an expansion capacity as per the following. This is what about the plan of spending. This is what about the actual spending. The company pays its bankers at the rate of 12% per annum. 12% per annum. Interest being debited on monthly basis during half of a year, the company had 10 lakhs overdraft up to 31st July. Okay. So, 1st April 2021 to 31st March 2021, 22. Up to 31st July 21, okay, 10 lakhs overdraft. They had overdraft of rupees 10 lakhs. And surplus cash in August. In August, overdraft being 0. They have surplus cash. Means that time there is no borrowing. Okay. Surplus in August and again overdraft to over 10 lakhs from 1921. So from 1921, this period surplus. Thereafter, from this period onwards, thereafter, again overdraft was there. How much is that? 10 lakhs. The company had a strike during June. June month there is a strike, so there is no spending. See, work was again commenced on 1st July and all work were completed by 30th September. Work got completed by 30th September. Once the good work is completed, you are not eligible for capitalizing thereafter. Assume that the expenditure was incurred on first day of each month, 1st April, 1st May, 1st June. That's how they spend. Calculate the interest to be capitalized. Give the reason wherever necessary. One of the interesting illustration. What about the spending, sir? Capital expenditure. April 2 lakhs. April 2 lakhs. Now what about the overdraft on the date? 10 lakhs. As overdraft is more than capital expenditure, you pay the interest for the 10 lakhs, but you are eligible for capitalizing only to the extent of 2 lakhs. At what rate? 12% per annum, otherwise 1% per month. How much you can capitalize? Interest capitalized 2,000 rupees. Now in the year end, okay, clear, in the year end, interest capitalized. Your asset value being work in progress value, capital work in progress value being how much? 2 lakhs spent, 2,000 capitalized, then 2 lakhs 2,000. 2 lakhs 2,000. Clear? 2 lakhs 2,000. Clear? Interest and capital work in progress value. Spending plus this one 2 lakhs 2000. Now, in May 1, already 2 lakhs 2000 is there. Again, you spend another 3 lakhs. Now, the property value being 3 lakhs 2000. Am I right? 5 lakhs 2000. 5 lakhs 2000. Am I right? What about the overdraft by the time? 10 lakhs. Overdraft is more than this spending. So, you may pay interest for the 10 lakhs. Means 10,000 you may pay the interest. How much interest can be capitalized? Interest on this being 1%. 5,020. 5,020 or 10,000, whichever is lower can be capitalized. Whichever is lower can be capitalized. Any interest you capitalize in case of general borrowing, it should not be more than the actual interest paid. The actual interest paid being 10,000, the capitalized interest is 5,020. Okay, you can capitalize only 5,020. Okay. So, interest on spending and interest on overdraft. First case 2000, here it is 10,000. Between these two, whichever is lower can be capitalized. Second year, this is 5,000, second month 5,020. Interest as per the loan being 10,000, whichever is lower 5,020 is capitalized. Now, what about the closing work in progress value, capital work in progress? 5 lakhs 7,020. In June, what about the overdraft? June overdraft 10 lakhs, July overdraft 10 lakhs, August overdraft nil, September overdraft being 10 lakhs as per this one. Is that okay? Now, interest for every period being 10,000 every month. As we don't have the overdraft in August, we don't have any interest to be payable. In September, 10,000. In June, initially 5 lakhs 7,020, but we don't spend anything, so the value remains same. Now, what about the interest on this borrowing, this spending? 5,070. 5,070, I can round up this. So, how much you can capitalize? Okay, capitalized interest. Interest spent and interest on overdraft between these two. Interest on the spending, capital expenditure, and interest for overdraft between these two, whichever is lower. 5,070. Now, closing capital expenditure being 5 lakhs 12,090. The next period, we don't have any spending. This becomes automatically eligible for capitalizable interest. 5 lakhs 12,090. Now, what about the interest on capital expenditure? Interest on capital expenditure being 5,121. 5,121. Is that clear? So, in the book, I showed this as 120. I go with that same to have the book value here. Okay. You follow 121 also. No, correct. That is also correct. Okay. Now, between these two, whichever is lower, 5,120 can be capitalized. Sir, this period is temporarily suspended, sir, due to strike. Due to strike, any operation stopped, abnormal reason. In that case, usually interest will not be capitalized. But here it is capitalized. You can state, sir, I will not capitalize because of this reason. No, because it's an abnormal issue. Capitalization is suspended. That's how you can give the answer. Okay, you can give the answer. I have to discuss that theory finally. Okay, okay. Anyhow, here. Now, what is the total value? 5,17,210. And August month, 5,17,210 plus that month spending 1 lakh. So now the spending being 6,17,210. Interest on your capital expenditure being 6,172. But you don't have the overdraft, so you don't pay any interest. So as I already told you, interest capitalized value should not be more than interest actually spent, actually paid. Here actually paid is 0, so nothing is capitalized, 0. So year end the value becomes the same, 6,17,210. Next year you have to add up these two, then the ultimate value being how much? 13 lakhs 17,210. Now for this 13,172 will be the interest on the spending, but interest paid on overdraft is 10,000. Between these two, how much is capitalized? 1,10,000. Sorry, only 10,000. So 1 lakh 13 lakhs, 27,210 will be the final value of your capital work in progress, or in hereafter it's an asset. Hope now you'll be able to understand this concept. Any doubts here? Online students, come on, respond me. Now, the last component I have to explain, no, the suspension. See here, the one few more theories there. Okay, few more theories are there. So now you'll be able to understand the last point. So I didn't explain by the time because I need to explain this along with the illustration. Now you'll be able to understand this logic better. Capitalization. 3 conditions for commencement of capitalization. One is you need to incur the borrowing cost, and activities essential to prepare the asset for intended use is ready. You are working on construction. Construction also started, borrowing is also started. So construction being 1/1/2026, borrowing being only 1/4/2026. Then when you can capitalize the interest? Only from this date. Okay, because there is no borrowing cost here, you cannot capitalize. Expenditure for acquisition, construction, or purchase of qualifying assets. Any amount you pay for interest, okay, expenditure on qualifying asset. Or if you are having any other asset also used for constructing this qualifying asset, you already have an asset, steel you have in stock. You converted the steel for your asset construction. Also be the cost will be considered. Interest bearing securities will also be added. If you are getting any revenue will be subtracted, government grants will be subtracted. This will be the complete expenditure for the qualifying asset. Now, suspension of capitalization. Suspend when active development is interrupted. 4 years construction period. In that 6 months, due to some abnormal reason, strike, lockout, or any accident happened in the factory, construction got totally disrupted. During which period any interest you pay cannot be capitalized. Suspend that and again resume once the operation is started, resumed. Don't suspend for temporary delay due to technical and administrative work. Suddenly there is a technical issue. So you waited for around 1 or 2 months to get the expertise support. No need to stop the capitalization. Okay. So in the last illustration, it's a strike. In that period, you can suspend. If you suspend, then you have to give this fine and say, because of that reason, I have not capitalized in this period. That's how you can say here. Which period? This period. This 5,070, no need to capitalize. That's another approach. You can now note, abnormal, it may be not capitalized, but I assumed it may be a allowed capitalized value, so I added. That's how you can give the hint. When you stop capitalization, when we stopped the last month of September, because the work is completed, ceases when substantially all the activities necessary to prepare the qualifying asset is completed. Then you can stop capitalizing thereafter. Now, what are the disclosure? What policy you followed? What amount you capitalized during the period should be disclosed. Okay. With that, This standard is completely over. AS number 16 is complete. Now let me start with AS number 11. AS number 11. So AS number 11. The effects of changes in foreign exchange rates. The effects of changes in foreign exchange rates. What happens if you are involving any transaction with foreign countries? The settlement is routed through foreign currencies only. No. You're supposed to pay today, but you get the 3 months trade credit. 3 months later, while paying, the value may be either higher or lower. Because of that reason, you may either face profit or loss. How can we handle? And what are the nature of transactions will be there? So these are the things that are going to be studied here. Now, the effects of changes in foreign exchange. The effects of changes in foreign exchange rates. Determination of exchange rate to be used. What rate to be used? You might have studied in branch account, foreign branch. Closing assets are converted using the closing conversion rate. For the nominal items, you need to use the average rate, same. What rate you have to take? And because of that, the financial effect, is there any loss or gain? What do you do? Debit to P&L account some cases, or it may be accumulate to foreign currency translation reserve account, depending upon the nature of treating your branch. That is given here. Applicability. Okay, applicability. So we have three types of transactions. Three types of transactions to be considered. One is transaction. Okay, transaction. Another one is translation. Another one is foreign exchange contract. This translation is nothing but translating the financial statement prepared in foreign currency into the home currency. That's what you studied in your branch account. Your branch is in foreign country, they gave you trial balance in their foreign currency, you converted that into Indian currency. Okay, that is called translation. Sorry, this is called translation. Translating from one language to the other language. Translation of financial statement of foreign operations may be subsidiary, associate, joint venture and branch in another country. This component you included in your branch accounts. Is that okay? So here, this second part is pretty simple. The illustration what you have solved in that is from here only, in this chapter only. Isn't it? This sum you solved there, right? S&M Limited, Bombay have branch in Sydney. So Sydney branch gave their financial report in Australian dollar. Now you have to convert that to Indian rupees. While converting that to Indian rupees, you have to use these rates. Okay. Based on that, you can consider transfer. You consider that Sydney branch as a integral part of your business. What is that? Integral part of your business. Integral means that branch is part and parcel. If that branch is part and parcel, any profit and loss on conversion is going to be debited to your P&L account. That's your own business, no? That's how we might have solved the branch account in our book, right? Am I right? See. The exchange loss, 216. Transfer to the P&L account if it is being integral. Integral. Is that clear? That's the logic. Now, in case of foreign branch, usually accounts maintain independent accounts. Independent branch, dependent branch, that's how we saw. In case if you have the branch in foreign country, usually that will be treated as independent branch. And in the currency of the country in which they operate, they report in their own currency. Translate into the reporting currency. Reporting currency means for which country you are going to report. In that nation's currency you have to convert. Last illustrations are different in branch account. Two illustration was there. First illustration is Normal. Second illustration is all about converting your currency to foreign currency, and there usually you make the mistake. Usually you divide that number, but here you have to multiply. You have to do the cross verification. Have you done that? Go and cross check. That's very, very important. Now, in case of foreign branch, it will be considered as integral foreign branch or non-integral. In case integral foreign branch, foreign operation is integral part of the reporting enterprises and considered as an extension of the reporting enterprises. In that case, any exchange loss will be transferable to the P&L account. Another one being the other way. That is separate, this is separate. The branch is no way connected with the head office. I will consider that being a separate third party entity. Like other than integral operation, this will be called as non-integral foreign operation. Change in the exchange rate does not affect the reporting enterprise's individual item, because any change resulting in any profit or loss, that will not be transferable, adjustable in the profit or loss of the reporting country, but adjusted in net investment in the non-integral foreign operation. That will be called as net investment. So this will be otherwise named as foreign currency translation reserve. As you are going to keep this separately under foreign currency translation reserve account, will not affect your P&L account. Hope you will be now able to understand. How do you convert that values? If you are considering your foreign branch being integral foreign operation, revenue items are converted using average rate, and balance sheet items, monetary, non-monetary, closing assets if any. Closing assets converted using closing rate. In case of non-monetary fixed assets purchased 5 or 10 years ago, then that date's rate will be taken for the conversion. In between, since the date of purchase sometimes later we have underwent for revaluation, then you have to convert based on the revaluation date. In case of monetary, like debtors and creditors, BR and all these things are monetary. In that case, you have to use a closing rate only. In case of non-integral foreign operation, revenue item also average rate, and balance sheet item, all the balance sheet items, closing exchange rate. Revenue items are average rate or rate at the time of transaction, which is not possible because every day there will be buying and selling happens. So then you have to convert that based on that date's conversion rate. That date's conversion rate, which is really tough for your calculation, but practically they are doing. Then and there, whatever the rate transaction happens, that date rate is applied for converting. Okay, probably you can use the average opening plus closing by 2. That's how you can do. All the balance sheet items are converted using the closing rate. After the conversion, if there is any change, difference is there, the trial balance will not agree. If the trial balance is not agreeing, the difference will be either profit or loss transferable to the P&L account if it is being the integral foreign operation. In case of non-integral foreign operation, that will be kept under foreign currency translation reserve until how many years? Until that investment is disposed, that branch is completely closed, it remains there itself. In the very first year, you consider this being integral foreign operation. Sometimes later you converted that to non-integral foreign operation, or sometimes later it is converted back into integral. That's what about change in accounting policy. Because of this change, so if you are changing from here to here, whatever the amount already debited, is now transferable to the foreign currency reserve. If you are converting from this to this, any reserve you have is now transferable to the P&L account. Clear? That's all. Now, accounting. Okay. So here the examples are given. Now, we'll see. Other points. What is called transactions, sir? Buying and selling of goods or services in foreign currency, lending and borrowing. It's an action between the two parties, buying and selling. And acquisition or disposition of assets or any other commitment you're supposed to settle. Those things are called transaction in foreign currency. Let me explain this concept very simple. Thereafter, I will cover up the rest theory. Transaction related items are going to be handled now. See, Very simple illustration. Transaction related, translation related, forward contract related. Translation we learned there, but here we in advance we have learned what? Non-integral case also. Integral case we already incorporated in branch, here non-integral case. The difference will be named as foreign currency translation reserve. Okay, that's all. In case of transactions, what? Buying and selling. You purchased, but the money payable sometimes later. See, it's very simple, so I'll finish up just like that. Purchases and payables. Come on, tell me, what is the journal entry for this? The following details are provided by an import house. Goods purchased on 4th August for $20,000. By the time per dollar is 70. 14 lakhs is the value you pay in terms of rupees. What is journal entry? On 24th August 21, purchases account debit to creditors. How much? 14 lakhs. 14 lakhs. The date of payment being 25th March 21. While making the payment, creditors account debit 14 lakhs you have to pay to bank, but to bank. While making the payment, I have to pay at the rate of 72 rupees by the time the rate is increased. So $20,000 into per dollar I have to pay 72 means how much I have to pay? 14.4 lakhs. As per my books of accounts, amount payable to the creditors is only 14 lakhs. That additional 0.4 lakhs I paid due to the exchange is now debited to the P&L account. That's all. Reverse also possible. Gain may also be possible. Credit to P&L account. This is called transaction exposure. Exposure means risk. Risk is nothing but any amount you're supposed to pay is not as per your contract. There may be change. Either it may be positive side or negative side. That is called exposure. If anything favorable for you, then it is credited to the P&L account. Unfavorable, debited to the P&L account. That's all. One more thing. What's that? Purchase and settlement happened within the financial year itself. Suppose here, if the financial year ends on 31st December 21, on the date the rate is 71 per dollar, how can we treat? For this period, again, you debit P&L account to creditors to the extent of increase happened here. Clear? If the purchase date and settlement date falls within the due date, within the year end itself, no problem. If the payment falls after the year end you need to do one more adjustment. For that, we'll see the next illustration. Let's see. Come on, tell me. August, what is the journal entry? Purchase to creditors 14 lakhs. Okay, 14 lakhs. But before the payment year end comes, 31st March. On the date itself, you are aware about that. Definitely, you have to pay 2 rupees excess per dollar. But anyhow, you are not going to pay. It's a due. So the entry being loss debit to amount payable to the creditors increased by 2 rupees per dollar for 20,000. You have to pay 0.4 lakhs excess. Clear? And actual payment date being 25th May 22. By the time amount payable to the creditors as per my books, our book being 14.4 lakhs. But the amount payable in this case being on the date per dollar is 74. 74 into 20, then 14.8 lakhs you have to pay. Again, you are paying another 0.4 lakhs excess can be debited to the P&L account. Clear? That's all. Hope you'll be now able to understand. Clear? All these things are pretty simple only. Now, we have seen purchases and payables. Then what could be the next one? Sales and receivable. Come on. Try to solve this illustration. What could be the entry? Z Limited sold goods to US company on this date for $50,000 and realized the amount on 36/24. This is what about sale date. This is what about year end. This is what about the received date. You have to pass the entry on this date. It's a sales, right? So debtors account debit to sales. How much is that? 50,000 into 65.4, 32.7 lakhs. Second entry being, as year end comes in between, you have to adjust for the date separately. Now you will get 60 paise more. If you are receiving more, then you are happy. So credit to the P&L account. Debtors account debit. He will pay me more. Transfer to the P&L account. Credit side. 60 paise into 50,000. What is the value? 0.3 lakhs. 3 lakhs? 0.3 lakhs. Okay. Okay, 30,000 rupees. Next, on the settlement date, you got 20 paise lesser loss. So, amount recoverable from the debtors being 32.7 plus 0.3, 33 lakhs. But you get how much? Only 65.8 into 50,000. You will be getting 32.9 lakhs only. Now you got 0.9 lakhs lesser is loss. Debit to P&L account. Clear? This is what about the transaction related. Transaction related. Now, let's move on to the next illustration. Next illustration. I'll solve the question number 5 after. Let me finish up question number 6 first. You have to understand what is called reporting or functional currency and foreign currency. The country where you need to report your financial statements in consolidated manner, no, that country's currency is called reporting or functional currency. The branch operated other way place will be called as foreign currency other than reporting currency. Is that okay? The term is given here. Now, we'll discuss this one. Short-term borrowings case. Short-term borrowing case. This is also similar to the same way. Rather than buying and selling, you are now borrowing. Also transaction. Yes, come on, tell me. Springley Limited borrowed $6 lakhs on this date, which will be repaid on this date. So this is what about the borrowing date, repaid date. This is year end date. Now you have to find out what? You have to pay the pass the entry for this date, pass the entry for this, pass the entry for this. At the time of real borrowing, you have to pay 64 per dollar for the 6 lakhs. Borrowing, you get the collections, bank account debit to lender account, to lender, okay, or borrowings account, borrowings. How much? 64 into 6 lakhs? 384 lakhs. 384 lakhs. Meanwhile, by the first year end itself, dollar rate increases by 0.5. So you are pretty sure you have to pay 0.5 excess. If you are supposed to pay 0.5 excess means loss. Debit to P&L account to borrowings. How much borrowing you have to pay excess due to the exchange difference? 3 lakhs. 0.5 into 6 lakhs, 3 lakhs you have to pay excess. And here 25 paise you have to pay excess on real settlement. The amount payable to the borrowing balance as per book being 38 plus 384, 387 lakhs. But the amount actually you pay in this case being 64.75 into 6 lakhs, 388.5 lakhs. You pay 1.5 lakhs excess due to this reason, 0.25 excess you pay for for 6 lakhs. No, this will be debited to the P&L account. Clear? This is what about the short-term borrowings. Short-term borrowings. Is that clear? Now, shall I move on to the next one? The earlier illustration. What happens in case of asset purchase? If you borrow and purchase the asset and the payment may be made later on where there may be difference in payment. You have studied that in direct taxation, section 43A. Any asset purchased out of the foreign countries borrowing, forex borrowing, while repaying, if you are supposed to pay excess amount, that will also be capitalized. Section 43A. Section 43, class 1, actual cost, 43A is forex related cost. Paras Limited purchased a machine costing 72 lakhs on this date. Machine costing 72 lakhs on this date. And the same was fully financed by foreign currency, payable in 2 annual equal installments, exchange rate being 57.6 and 60. Okay, as on 1/4/2014 and this date respectively. First installment was paid on 31/3/25. What is the amount of difference charged to the profit and loss account for the year 24/25? Okay. Now, 72 lakhs means what could be the dollars purchased, borrowed. By the time 57.6 rupee will be per dollar's worth. The number of dollars borrowed being, come on. 1,25,000. Yeah, $1,25,000 is the purchase value. Okay. Now, by the first year end, how much extra amount you are supposed to pay here? 2.4 per dollar you have to pay excess. So, into 2.4 will be debited to the P&L account. Debit to P&L account. 3 lakhs should be debited to the P&L account. Sir, can I capitalize this? Of course, you can capitalize. Either it can be debited to the P&L account or you can capitalize. Two options are there. In case of borrowings related to the asset purchase, if there is any excess payment or lower payment, it will be adjusted to the cost of assets acquired. Cost of the asset acquired being the value of the asset measured as on the date of acquisition date. Suppose the payment made sometimes later, lower or higher, will have the impact on this. If you are paying lesser, minus it. If you are paying more, add it. So, 72 lakhs, hereafter the assets value will be shown as 75 lakhs. This is one approach. No, sir, the asset value is only 72 lakhs, sir. This 3 lakhs can be debited to the P&L account. It's another approach. Adding to the cost will be called as optional as per the para 46A approach. It's optional. It is optional. We'll see that in the next illustration. Is it clear? Only related to the fixed assets. Shall I go for the 46A? So, with that transaction related exposure completely over, the last one. Under this, I will discuss two illustrations. 46A para. So, what 46A says? And then this is optional. Exchange difference is not transferable to the P&L account. that can be related to depreciable asset means added from such assets, deducted or added to the asset. But if the exchange difference not related to the depreciable assets, may be other assets other than depreciable assets, then that amount will be named as foreign currency monetary item translation difference account. That will be a separate account you have to keep. Recorded on the head of reserves and surplus account and amortized over the life of the loan. Okay, I borrowed. Why do you borrow? Is it for any depreciable assets purchased? No, sir. General borrowing. General borrowing not related to any other assets. Okay, no problem. In that case, any exchange difference is supposed to pay you, no, will be named as FCMITD, foreign currency monetary item. That is what is called monetary item. Debtors, creditors, loan, not related to asset. And it will be kept under foreign currency monetary item translation difference. And loan is repayable 5 years, means this difference will be amortized over the 5 years period. Will be shown under reserves and surplus account. In case of gain, shown under reserves and surplus. In case of loss, shown under the reserves and surplus in negative. Clear? In negative. Now, long-term borrowing for depreciable assets. For depreciable assets. First aspect is depreciable assets. Another one is monetary assets. Okay. Monetary liability. Let's try to solve that. Yeah. Come on. A Limited purchased fixed assets costing 3000 lakhs rupees on 1121 and the same was fully financed by foreign currency. Payable in 3 annual equal installments. $40, $42.5 on these 2 days. On purchase, 40 per dollar. Thereafter, it is $42.5. Now, what could be your purchases? 3000 rupees per dollar, 40 rupees means how many dollars you could have borrowed? $75 lakhs you might have purchased. Okay. What is the journal entry on purchasing the asset? Asset account debit to borrowings. How much is that? 3000 lakhs. 3000 lakhs. Is that clear? By the end of first year, value increases from 40 to 42.5. Because of this reason, for 75 lakhs dollar, you have to pay 2.5 each excess payment. Loss, no, excess payment is nothing but loss. How much is that? 187.5. What can we do? That can also be debited to asset account. Asset account debit to borrowings. Asset account debit to borrowings. The value being 187.5. Now, if you want to depreciate, the life may be 5 years. How can you depreciate? 3000 after inflation, this value being 3187.5 divided by life of the asset. This is how we can depreciate. Clear? In case of borrowings related to a depreciable assets, para A option can be exercisable. Otherwise, earlier one. What's the earlier one? Normally, anything can be debited to the P&L account or credited to the P&L account. Okay. Related to the interest, then we had the other model. Any excess interest you pay means the exchange difference if you face being the loss, the interest saved extent will be capitalized. That's how we saw there. But here, exchange difference only. If the exchange difference related to the asset, usually debit to P&L account or credit to the P&L account. Okay. But if you add the section means para 46A, then that can be now part of your assets and borrowing. No need to debit to the P&L account. Amortized over the life of the loan. Amortized over the life of the loan. Clear? Now, hereafter the depreciation entry being depreciation account debit to asset 3187.5, life being 5 means 5, you are divide this by 5 for the depreciation. But of course, this is for understanding purpose. There is no question in this. Can I go for the last one? Last one of this. Thereafter, we have to go for the forward contract. Loan is for other than depreciable assets. What can we do? In case of loan is for other than depreciable amount. That excess payment, lower payment will be temporarily kept under foreign currency monetary item translation differences. And that difference will be amortized over the loan period. If the loan is repayable in 5 years, this amount will be amortized over 5 years period. That's all. Loan is borrowed for 5 lakhs when the exchange rate is 75. 5 lakhs dollar, 75 lakhs. And what is the borrowings entry? Bank account debit to borrowings 5 into 75, 375. What is the journal entry? Bank to borrowings 375 lakhs. 375 lakhs. This is on borrowing 1420. Exchange rate were 78, 80 on these two dates. So 1 year later, 31/3/21, you know that you thought you will pay only 75, but you need to pay 78, 3 rupees excess. 3 rupees excess. Is that okay? Then that 3 rupees should also be addable with the borrowings, named as foreign currency monetary item translation difference account debit to borrowings. Borrowings will be repayable higher by 3 rupees per dollar for 5 lakhs. 15 lakhs you have to pay excess. 15 lakhs you have to pay excess. Right. Now, how can I amortize this over the life of the repayment loan? Loan is repayable in 5 annual installments. So this 15 lakhs amortized over 5 years period. For that, P&L account debit to foreign currency monetary item translation difference 15 lakhs divided by 5, 3 lakhs, 3 lakhs. Okay, on borrowing on first year end. We'll go for the second year end 31/3/22. By the time the conversion rate still increases from 78 to 80, means you have to pay 2 rupees excess per borrowing, also loss debited to where? Foreign currency monetary item translation difference account debit to borrowings. 2 rupees means for 5 lakhs. See here, this 5 lakhs is repayable in 5 equal installment. Every year you pay 1 lakh. First year you pay 1 lakh, thereafter balance being 1 lakh, 4 lakhs, then another 1 lakh, 3 lakhs. Now already you paid 1 lakh, now the balance being only 4 lakhs. You have to pay 2 rupees excess only for the remaining loan payable. 8 lakhs will be the value. 8 lakhs will be the value. Whatever the amount available in foreign currency monetary item translation difference is going to be amortized over the life of the asset, the life of the loan. 8 lakhs will be amortized. What is the remaining life of the loan? 5 years already, 1 year over. So still we have 4 years only. So 2 lakhs. Not only this 2 lakhs, this one also be included with this. Now P&L account debit to what? Foreign currency monetary item translation difference being 5 lakhs. This 3 lakhs will be amortized every year for 5 years. In the second year end, another 2 lakhs will be started to be amortized for the remaining 4 years. So for the second year, 3 lakhs plus 2 lakhs, 5 lakhs will be amortized. 5 lakhs will be amortized for the remaining another 3 more years. Who knows in the next year if anything happens bad, still you have to go for amortizing further. If there is a gain, can be adjusted. You can reverse that foreign currency monetary item amount can be reversed by crediting. Clear? Hope now you will be able to understand. 46A option provision also. Option provision also. See, translation transactions. Now I am going to deal with forward contract, forward hedge, forward exchange contract. Forward contract is nothing but booking ahead, reservation like I purchased some commodity, I have to make the payment matter of 3 months later. On purchase, per dollar is 80. Per dollar is 80. The supplier gave me 3 months credit. I'm pretty happy. But 3 months later, per dollar is 85. What happens? My happiness is problem now. Is that okay? Rupees 85 per dollar. This fellow says, I asked you $1 only, sir. Okay, I gave you 3 months also credit period, sir. What can I do? For the 3 months period, the dollar increased to 85. Now I have to pay 85 to purchase the dollar and give to you. Say, unwantedly, there's a loss of 5 rupees. Then what can I do? I want to safeguard this position. Also, I want to enjoy 3 months credit. In order to safeguard yourself, you can pay today itself, no problem, no tension. But you want to enjoy the 3 months credit period also. Enjoy, but you should not face the risk. What can we do? Reserve, you do the reservation. Just like you do the reservation for the bus ticket when the huge demand is there. Similarly, you can reserve for purchasing the share. Book the shares to be purchased, means dollars to be purchased with the banker. Go to the banker. Sir, I need $1, sir, 3 months later. How much I need to pay, sir? Immediately banker says, you need $1. Okay, good. Give me some margin money, 5 rupees, 3 rupees. Okay, I'll give. Banker will purchase dollar for 80 rupees today and he holds on behalf of me out of his own fund. Banker now what will do? For the 3 months, no, he charges interest. Probably he charges 50 paise interest. He demands me to pay 80.5. So I have a risk to face the price may go higher in 3 months period. Ultimately, it ends with huge payment. But now, just paying another 50 paise excess money to the banker, I am now guaranteeing to purchase a dollar from the banker at 80 rupees 50 paise. That 50 paise is usually not called as interest, it is called as premium. This is named as forward. Forward means you are purchasing not today, future period, forward period. That's called forward exchange contract. Why do you now book with the banker? Why do you now book with the banker? You need to pay, you are in need of this. That's why you enter into the contract. It's nothing but preventing yourself from the risk. Otherwise, compounding your house. Compound. Why do you use the compound? To safeguard your house. The another term for the compounding is nothing but hedging. Hedge is nothing but compounding. Now, 85 is a risk, no. To prevent from the risk, you need to have the compounding. What is the compounding? Entering into the forward contract. So now entering the forward contract for this purpose is called hedging. Actually, the future and forward contracts came only for the hedging purpose. Safeguarding from the risk. For that purpose only came. Another fellow hearing about this matter, he doesn't want the dollar, but he knows that the dollar price will be 80, 85, 86 or sometimes later. Immediately goes to the banker, sir, I need dollar by the end of 3 months. Give me 2 rupees to book in advance. How much will be the price? Today 80, 3 months, no. You'll pay me 1 rupee excess, 81 rupees. Okay, sir, I will purchase at 81. Why do I want to purchase? No, I don't have any intention to purchase really for my requirement. But I expect that the price will go up to 85 3 months later. By the time I purchase from the banker for 81, sell it to other persons who are in need for 85 to make a 4 rupees profit. Then this is called trading or speculation. Trading or speculation. Hope you'll be now able to understand the difference between hedging, trading and so forward exchange contract could be entered for hedging purpose or entered for trading or speculation purpose. In case of hedging, how can we treat? In case of trading and hedging, how can we treat? In case of trading and speculation, how can we treat? That's all. Okay. Okay. Now let's see forward exchange contract meant for hedging purpose. Meant for hedging purpose. Okay. In case if it is hedging purpose, that excess payment you do know, currently the rate being rupees 80 per dollar, and you enter into the hedging contract with the banker demands, sir, you pay 81.50 per dollar, sir. I will guarantee supply the dollar at 81 rupees 50 paise by the end of 3 months. Per month 50 paise. Per month 50 paise. If I don't enter in this contract with the banker, I have the risk. If the price goes up 85, 86, then I have to pay 5 rupees or 6 rupees excess. Anyhow, now by paying 1 rupee 50 paise excess, you are guaranteeing what's your outflow. In this case, that difference 1 rupee 50 paise, you know, that is called forward contract premium. This can be debited to the P&L account as per the matching concept. As per the matching concept. For example, this is for 3 months. This is for 3 months. You enter in the contract on 1st February 2026. The contract expires on 30/4/2026. Year ends on which date? 31st March 2026. Now you pay 1 rupee 50 paise excess for this period, and your year ends on this no. So in this tenure, 2 months related to the current period, 1 month related to the other period, next period. Then out of 1 rupee 50 paise, 1 rupee can be debited into the P&L account of this period, another 50 paise can be debited to the next period. Right. Rukmani Limited purchased plant US dollar 2.5 lakhs. On 1st March 2015, payable after 3 months. Payable after 3 months. Okay. So I gave the same example. So 1st March 2015, 3 months period. Okay. 1st June 2015. Now what about the year end? 31st March 2015 will be the year end. This is the tenure of your forward contract. In that, 1 month falls in this current year itself, 2 months falls in the next year. Right. The company entered into a forward contract for 3 months, 54.10 forward rate being 54.1 per dollar. Okay. Exchange rate dollar on 1st March on entering today date rate will be called as spot rate. Spot rate 3 months later means you can purchase it for 54.10. Spot it is 53.74 per dollar. Compute the amount of profit or loss forward contract as per AS number 11. Come on, tell me. What is the excess amount you pay over the 3 months period? 0.36. 0.36 per dollar for the 3 months. Then for the first month it is 0.12. For this period it is 0.24. Is that clear? 0.12 should be debited in the P&L account of the current year. Remaining will be debited in the next period. 0.12 per dollar. What is the total dollar you now supposed to pay? 2.5 lakhs. 2.5 lakhs into this value. How much is that? 30,000 in this period. Balance being 0.24 into this one. 60. So overall value 90. Out of that, 30 is debited in this period, 60 is debited in the next period. Like normal one. Like normal. Clear? Next one. In case forward exchange contract for trading or speculation purpose, then automatically mark to market concept comes. Mark to market. No need to confuse with that term here. As on 31st March 2025, there will be one more rate given. Based on that rate, you have to adjust. You will study at final level what is mark to market and all, how can we adjust. In case of forward contract, spot rate, forward difference will be amortized over the tenure. In case of forward exchange contract for the trading and speculation period, year end comes in between then that date one rate will also be given. One rate will be given. Like earlier, no, we adjusted for payables and receivables. As on 31st March, if there is any difference, we will adjust. No, similarly, you have to adjust here also. Clear? Let's see. Let's see. Forward exchange contract, trading or speculation. A dealer has bought 3 months forward US dollar 1 lakh at 47.10 per dollar. So forward, when purchased it 1/6/2018. Okay, for 47.10. Actually, in subscript you can mention the tenure also 3 months. Dealer closes its accounts on 30th June. 30th June 2018. If it is 3 months, means when it is going to get over? 3 months later? 1/9/2018. This is the end date. As on the date, you have to see mark to market value. Mark to market value means that date your value will be given. From the date to this date, how many months are there? 7 and 8, 2 months is there. So you need to find out the rate for forward 2. This is forward 3, you have to find out forward 2. Then on closure, expiry date, that will be called as expiry date. So 1/6/18 you need to know forward 3 rate. Year end, on closure you need to find out forward for the remaining period date. And this is what about the expiry date, 1/9. Sir, what happens if I cancel beforehand? That date is final. Okay, a dealer has bought 3 months forward contract for US dollar 1 lakh at 47.1 per US dollar on this date. The dealer closes the accounts on 30th June every year. Exchange rate on this date being 47.20. What is this? 47.002. This is what about the exchange rate on the date? 47.02. This is spot rate on this date. If you want to purchase today, you have to pay how much? 47.02. But today, you tell them I will purchase 3 months later, then the rate is 47.10. You have to pay 0.8 excess money. And on 30/6/2018, 47.15. 47.15. I don't want the spot rate, means the concerned dates rate I don't want. The concerned dates F rate is needed, forward rate is needed. Forward for the remaining period. So, on this date, 2 months forward contract was selling at 47.18. This is required. I never bother about these rates. I never bother about the rates applicable for any date. I need to know what about the forward rate for these dates. Forward rate may be forward for 3 months, forward for 2 months, forward may be 1 month or 10 days. Means up to the expiry date, how many days is there? No. You have to find out the forward for those days. Today, forward for 3, 1 month later, forward for 2, another 1 month later, forward for 1 month. Okay, I need the forward rates. On 15/7/2018, the dealer sold the forward. 15/7. In between, they sold 15/7. He doesn't want to wait up to the expiry date initially, because his intention is not to buy and settle on the maturity date. Intention is to make the profit. Buy whenever there is a huge profit for that, he will sell immediately. So in this date itself, he executed. In the date, at what rate he executed? 47.11. He sold at this rate, 47.11. So you need to understand the difference between rates for the specific date, and on a specific date, rate supposed to be payable sometimes later date. That is called forward rate. I am going to compare the forward rates only. Today forward 3, 1 month later is forward 2, 2 months later forward 1. Okay. Now mark to market will be done. What's that? On this date, I thought I purchased for 47.10. Now it is 47.18. You purchased for 47.1, but it is now 47.18. It means savings gain. Okay, you purchased the forward value for 47.10. 1 month later, the value being 47.18. Then this will be your gain per dollar. For how many dollars? 1 lakh dollar. Then what is the gain you have? 8,000 gain in P&L account. It can be credited. But he has not waited for the year end. Halfway through itself, 15/7/2028 itself, he sold. As on the date, you consider the value being 47.18, but you sold for 47.11. 47.11, and on closure you get only 47.11, but you consider this being 47.18. The sale value is less than your expectation. Your expectation is 47.18 on the year end, but now the sale value is lesser. For the 1 lakh, you lose how much? 7,000. This will be debited to the P&L account. This is debited to P&L account. Hope you will be now able to understand forward exchange contract in case of trading and speculation. Okay, two rates are going to be considered. Two rates are going to be considered. Now, clear. Now, to make you understand, let me give the example from stock market future. Stock market future. Let's see an example. Tax Consultancy Services Limited. 3,131.80 is the rate traded today. Spot rate. But if I want to purchase 1 month later or this month end, what could be the rate? The rate will not be this one. There will be some extra money you may pay. How can I know? Is it 1 month later or 2 months later or 3 months later? Then that will be called as in stock market future. In exchange market, foreign exchange market, it is forward. Future means it's routed through a proper channel and size is also same. Okay, but in case of forward, it's customized, routed through some brokers and third party or banker or dealer as per your requirement. How many dollar do you want? Sir, only $750. Okay, I will now buy $750 as per your requirement. But in case of TCS, that lot size is probably, I don't know what's the lot size. You may see that, okay. The lot size may be 100 or 200. You have to purchase that 100 shares at least. That's what about lot size. You cannot break the lot. And routed through medium only, okay. See, this is the future. This is the future. See, what is the price now? 3,140. What is the current rate? 3,131. So, if you want to purchase 3 months, this month end, how much you have to pay? 1,140. 7 rupees, almost 8 rupees you have to pay excess. 8 rupees you have to pay excess. If you pay 8 rupees excess, you will get the forward. Means you are having the rights to purchase this anytime before this month end. Tomorrow, if this price increases, what also increases? The 1 month price also increases. Immediately you sell that one. I can make the profit. Okay. This is spot market. If I want to purchase a TCS company share today, I have to pay 3,131. If I want to purchase 1 month later, 1 month later means November. Okay. I have to pay 3,140. This is the price. How much I have to pay? Only 10%. Because you are not purchasing, you are booking. For the booking purpose, you pay only 10% or 15% or 20% depending upon the scenario. They will have the margin money. Only you are paying 20%. So, see how they play. Rather than investing 3,000 rupees, if I have 3,000 rupees, I pay only 10%, means 10 is okay. 300 rupees is okay. I can buy 10 shares. With the same 3,000 rupees, I can purchase 10 shares. tomorrow even 5 rupees increase is there. 5 rupees increase. For the 10 share, 50 rupees increase is there. For my 3000, a day's revenue is 50 rupees. Instead of that, if I purchase 3000 rupees share today, tomorrow 5 rupees increase means investing 3000 rupees, I am getting only 5 rupees profit. So instead of buying spot, they will now purchase a future. How can I purchase? Can I purchase 3 months, sir? Yes, 3 months means January. If I want to purchase January, I have to pay how much? 1169. I have to pay 1169. If I pay 3169, almost 40 rupees excess compared to this because duration is higher. In the next month, I will check. Means 1 month later, this becomes what? Future 2. Another 1 month later, it becomes what? Future 1. Because by the end of November, or if you start December, you have December and January in 2 months. December, okay, then it's only 1 month left over. So I'm talking about the future price here. That is the logic. That is a few more theories related to this to be completed so that this chapter is completely over. Let me brief all the content for the comprehensive understanding. We started with the effects of changes in foreign exchange rate, applicability, transaction, translation, forward exchange. So we have completed all the 3. And non-applicability, where this will not be applicable. This will be applicable only for the reporting currency, not for the foreign currency. Okay, usually domestic currency. If you are preparing for India, India being the head office means you have to prepare the Indian currency value only as per AS number 11. Okay, cash flow statement. Okay, cash flow arising from transaction in foreign currency, translation cash flow in foreign currency also be recorded. And difference in exchanges. So for this AS number 3 is applicable, then automatically this will not be applicable. AS number 11 is not applicable. And difference in exchange due to AS number 16, we have seen no. AS number 16, borrowing cost. We have the options also. You can capitalize interest component to some extent. If you follow 46A, it can be added or subtracted with assets. In that case, this AS number 11 will not be applicable. And restatement of financial statement from reporting currency to the other currency. If you are preparing financial statement in Indian currency, as you are going to report in India, you have to follow AS number 11. For the better understanding purpose, you want to report your details in US dollar for foreign company. For showing that how big our company, you prepare some statement in foreign dollar to promote your business in foreign country. For that, AS number 11 is not required. So integral we have completed, and this one also completed. Accounting treatment for all the 3 we have completed, and this one also be not required, so we have completed. Illustration we have seen. Receivables, payable, cash, debt we have seen. Right. And translation completed. And how do I record also be completed. It's nothing but translation. Initially, how year on year balance sheet date, how can we show? And finally, we'll go for the disclosures. Amount of exchange difference. Included in the net profit or loss for the period. How much of exchange difference debited or credited in the P&L account, you have to disclose it. If anything accumulated in foreign exchange translation reserve and reconciliation, that details also be shown, because if you are considering this being non-integral part, you will show this being the foreign exchange translation reserve. Third, carrying amount of fixed assets during the accounting period. How much this will be adjusted in the fixed asset, whether it is added or subtracted, also be shown. In respect of outstanding foreign exchange contract, what could be the value? You should also disclose that. Outstanding exchange contract, forward contract. Any outstanding? No. In case of hedging, that remains amount to be chargeable in the next period. In case of mark to market, it will be adjusted then and there. Okay. This is the logic. Hope we have completed these illustrations. Over. Yeah.